Good morning, Mr. Bezos and all board members. Thank you for coming to our conference. My name is Tiantian Jing, and I'm the project manager of Amazon. Today, I invite our analysts Jen and Doris, and we're going to present a potential acquisition opportunity for Amazon. Amazon, as one of the big four tech companies focusing on e-commerce, cloud computing, digital streaming, and AI, it is a well-established industry with technological innovation and mass scale. Well, XPO is a tech leader in the transportation and logistic industry, spending around $500 million a year on software development and technological hardware. Amazon was believed to be XPO's single biggest customer, but it becomes more aggressive and has been making other moves to bring the transportation and delivery logistics in-house instead of relying on third parties. As a result, Amazon and XPO become competitors instead of partners. However, after the valuation of the XPO, we believe that Amazon acquiring XPO is a better decision for both parties. As to the strategic fit of our acquisition idea, we first think about a relevant industry trend. Firstly, Amazon's improvement in AI helped optimize the logistic process, while XPO does well in automation and intelligent machines. Secondly, Amazon Fresh has a high requirement for delivery of refrigerated shipped goods, while XPO is a supplier in the last mile delivery experience. Also, XPO is a Green 75 supply chain partner, which can help Amazon do better in an environmentally friendly process. The integration of the two brings economies of scale and a larger customer base. XPO is an important supplier of Amazon. Acquiring XPO helps Amazon eliminate intermediaries and therefore reduce costs. Secondly, transportation is important for Amazon. Acquiring XPO may take a lot of money in the short term, but will be paid back in the long term by providing faster shipping speed, better service, and ultimately increasing sales. Moreover, XPO experienced a drop of 14% in its share after losing Amazon, and a revenue decrease of $600 million in 2009 due to the loss of customers. Now that XPO is in a dangerous stage of continuing to lose customers, being acquired will help it regain orders from Amazon, will also get exposure to a larger customer base. We'll use the SWOT matrix to identify the strategies that we can utilize. Firstly, as one of the leading companies in its industry, XPO has a number of strengths that enable it to thrive in the marketplace. Automation of activities brought consistency of quality to XPO products. It has enabled the company to scale up and down based on the demand conditions in the market. It also has a high level of customer satisfaction, strong free cash flow, and a strong brand portfolio. Moreover, XPO is relatively successful at execution of new projects and generated good returns on capital expenditure by building new revenue streams. On the other hand, there are weaknesses where XPO can improve upon. For example, the profitability ratio is below the industry average. Its organization structure is only compatible with the present business model, and the financial planning is not done properly. Specifically, the current asset ratio and liquid asset ratio suggest that the company can use the cash more efficiently. As for opportunities for XPO, the adoption of new technology standard and government free trade agreement has provided XPO an opportunity to enter a new emerging market. Over the past few years, the company has invested a vast sum of money into the online platform, and this investment has opened a new sales channel for XPO. Also, lower shipping prices could bring down the cost of XPO and either boost profitability or pass on the benefits to customers to gain market share. The threats XPO is facing include intense competition and shortage of skilled employees. The rising costs can also lead to serious pressure on the profitability of XPO. Lastly, since laws are various in different countries, XPO may be exposed to various liability claims given change in policies in those markets. To place a value on XPO, We calculated how much the company is worth as a standalone company before the acquisition occurs by using both income approach and market approach. Then, we conduct a sensitivity analysis to valuation risks. We also identify the synergy values of the merger with which we can calculate the value after being acquired. I will now give the floor to our analyst, Jen.
Thank you, Tiantian. So now I'm going to show you our valuation analysis, starting from discounting cash flow. We first calculated the target WACC. Based on XPO's market value of debt and market cap, we find that its capital structure is about half-half, with a little bit more debt. Then for cost of debt, we used the average yield to maturity of XPO's outstanding debts times the tax benefit, which is 4.78% after tax. As to cost of equity, we relied more on CAPM because XPO's EPS was not growing at a constant rate, so the result of earnings cap may not be credible. Now, if we times the after-tax costs to their corresponding weight, we can get our final WACC, which is 9.55%. Then we need to estimate XPO's future free cash flow. We start from revenue. XPO suffered a revenue decline in 2019. Consider the effect of coronavirus. We expect it to continue declining in 2020, but recover the next year. Based on XPO's own estimation of 3 to 5% growth, we used a growth rate of 4%. We also made assumptions on operating costs and reached the EBIT numbers shown in the slide. We time it to 1 minus tax rate to reach NOPAT, and then add back depreciation, exclude CapEx, include changes in net working capital, and finally get free cash flow to the firm. Then, to calculate terminal value, we again estimated an FCFF growth rate of 4%, and our WACC is 9.55%. So the terminal value is $16 billion and NPV is $13.8 billion. This is also our estimated enterprise value. If we exclude net debt and divide by the number of shares, our final estimated stock price is $72.1. We also did a market approach as comparison to income approach. Here, we choose 5 comparable companies based on 2 criteria: capital structure and enterprise value. Point numbers like stock price are collected on April 13, while period numbers like revenue are for the past fiscal year. We calculated both price and EV multiples. We selected the average of each multiple and assigned more weight to EV multiples because they allow for direct comparisons regardless of capital structure. The concluded equity value per share is $109.84. Now, for both valuations, we did a sensitivity analysis to estimate the uncertainty of each model. For market approach, we simply calculated the worst and highest number of each multiple, and the price range is from $53 to $226. For income approach, we ran a data table using FCFF growth rate and WACC as variables. We ignored too high and too low rates, and an appropriate range is between $38 and $149. These are all for standalone price analysis. But what may be more important is the synergy value we can get from the acquisition. Recall what Tiantian illustrated as our strategic rationale. If combine XPO with us, we together can enjoy cost reduction by sharing resources on transportation and technology. Also, we will see revenue enhancement in XPO if we switch part of our orders from outside suppliers to XPO. These are the positive synergies, but we should not forget possible one-time costs, including acquisition fees and operating expenses during the integration. Here, I quantified them into exact numbers. From a conservative perspective, costs can be considered a sure thing and mostly occurred during the first year. Then, for cash inflows, the largest part is no doubt transportation savings. In the worst case, we expect a 10% saving on XPO's transportation costs, while in the best case, we may achieve 15% savings. And all these synergy values should be realized gradually over 3 years. Then, to discount these cash flows, we assigned 2.98% to costs because it's more certain, but we used a rate between WACC and the cost of equity for cash inflows because they are much riskier. The NPV for both cases are shown on the slide. To start our bid, we suggest that we only give 20% synergy value to XPO. This means $3.41 per share in the worst case and $5.42 in the best case. Now let my teammate Doris to make a summary on our valuation and then show you our financing strategy.
Thank you, Jen. I will talk about the final estimation of price. We will assign 80% to income approach because we assume XPO is at the growth stage, and we will weight from 20% to 50% of the synergy value of XPO and get the synergy value per share. We will add the standalone price with the synergy value per share to get the final bid-up price. We draw the football field. As you can see, the current price of XPO is in the lower end of each range, so it might be undervalued, and it's a bad time to acquire XPO. We suggest to acquire it in the range of this price. Now, after the valuation part, let's look at how to respond. As you can see, Amazon's EPS and PE ratio are much higher than XPO's, so we suggest to have a stock finance. Let's check Amazon's stock price. After 2020, it increased a lot because of the COVID-19. More and more people choose to shopping online. We suggest to have 100% of stock. Even though we issue 100% of stock, Amazon only issue more than 3 million of shares. It's a small number when comparing to the shares outstanding previously. That's because of the low exchange ratio of XPO. And after the deal, we own more than 99% of the ownership of the new company. So we will enjoy most of the benefits from the synergy. After the deal, the EPS increased a little bit. So this still benefit our company. In the sensitivity table, in the gray area, the EPS will increase after the deal, and in the white area, it will decrease. No matter we assume 20%, 30%, or 40% to premium to XPO, we will always enjoy an increase in the EPS. So it's very beneficial to our company. After the deal, the debt capitalization decreased a little bit. So this deal doesn't have any finance burden in our company. After the premium at 26%, we still have more than 10 billion value to shareholder to our company. It's very good. And in the combined balance sheet, you might ask me, how do I come up with the market value of XPO? Here are our assumptions. We assume it will have 100 million bad debt in current assets, and we consider the net PB&E as the plug-in. We acquire number from Capital IQ, and we times market price by the shares to come up with the stock price. Finally, we have the debt to capital ratio at 40%. Now let's look at the final recommendation. We recommend to acquire XPO at $84 per share. However, XPO value more than this amount of money because as a giant of the e-commerce, Amazon needs the technology from XPO to decrease its transportation costs and R&D costs and increase its revenue and customer satisfaction after customer receiving goods within several days. So it also decreases competition between Amazon and XPO. It's very beneficial, and we suggest to have the lowest price at 84%. But if other company want to bid the price up with us, we suggest not to offer a price of more than $93. That's the highest price that we will offer. And for the financing part, we suggest to have 100% stock finance because because it's much cheaper than the debt finance. And we suggest to have fixed value because we have confidence in our stock price. And just remind you of our price to offer to XPO at $84, and we will offer more than 7 billion to acquire XPO. Thank you for listening. It's a good opportunity in front of us to acquire the XPO. It not only can reduce our transportation costs, but also integrate the best advanced technology from XPO and increase our customer satisfaction. It's quite a good deal. I highly recommend you to consider it. Here are our references. Thank you for listening.